Hey everybody, today we're going to be taking a look at EVgo Stock and whether this is a good company to be buying right now or if this is something you should be staying away from. This is going to be from a long-term perspective. I think there's too many factors involved to say where the stock is going to be within the next few months or even within the next couple of years. So in this video, I'm going to try and answer the question of whether EVgo is a better long-term investment than something like the S&P 500. So I'm going to quickly go over EVgo's stock, then we'll move on to their latest quarterly report, where we'll see a much more in-depth look at the company's financial situation right now, and then I'm going to share my thoughts at the end. EVgo stock has been pretty volatile over the past month. You'll notice it's jumped quite a lot here within the past few days, and that coincides with the Federal Reserve's decision to keep the key interest rate flat, and they even hinted at some possible rate cuts that could come in 2024. EVgo is more sensitive to this kind of news because they still aren't a profitable business yet. This is EVgo's latest income statement covering the months of July, August, and September. You'll see their total revenues were at $35.1 million this year. And this is their total revenue broken down by the individual segments of their business. Their first line is retail charging revenue, which totaled $13.4 million this quarter. Then there's commercial charging revenue at $4 million, OEM charging revenue at $1.5 million, regulatory credit sales $1.8 million, OEM network revenue at $1.1 million, extend revenue at $10.5 million, and ancillary revenue at $2.8 million. So again, that brings their total revenues to $35.1 million, just like we saw on the income statement. Moving back to the income statement, they've got their cost of revenue up next. That totaled $35.9 million in the third quarter. Their depreciation totaled $8.6 million, and that brought their cost of sales to $34.5 million, which is just barely breaking even with their total revenues. So they ended up with a gross profit of only $604,000. But you'll notice this is an improvement from where it was 1 year ago. In the third quarter of 2022, they had a gross loss of $3.2 million. Continuing down, we've got their operating expenses, the first being general and administrative expenses. Those totaled $32 million in the third quarter this year, which is mostly unchanged from where it was 1 year ago. Then they've got depreciation, amortization, and accretion. That was almost $5 million this quarter, which is a bit higher from where it was a year ago. Their total operating expenses, adding these two together, those totaled almost $37 million, and their operating loss was $36.4 million, so it is moving in the right direction over the past year. Continuing on, they've got interest income of $2.9 million, change in fair value of earnout liability, $442,000, change in fair value of warrant liabilities, $4.8 million, and total other income, adding those together, came out to be $8.1 million. So their loss before income tax expense and after it, because they didn't have an income tax expense here, was $28.3 million. That was EVgo's net loss in the third quarter this year. But then we get to the non-controlling interest, and I think this is something many people aren't familiar with. This comes into play when the company, in this case EVgo, has a controlling stake in another company, making it a subsidiary of EVgo, but they don't own 100% of the equity in that subsidiary. And because EVgo has a controlling interest over those subsidiaries, the financials from those subsidiaries get consolidated into EVgo's income statement, as well as on the balance sheet, which we'll see pretty soon here. For most companies, this isn't a very significant amount, and a lot of times you won't even see any non-controlling interest at all. But in EVgo's case, $18.5 million of that net loss is attributable to the non-controlling interest, and that leaves the remaining $9.7 million of the net loss attributable to the Class A common stockholders. And at this point in time, because EVgo is still not profitable and this is a net loss, you could kind of argue this is a good thing because there's less of a loss for the common stockholders. But eventually, we would hope EVgo can generate a net income, and this number would no longer be negative, and that non-controlling interest would basically be taking away a portion of that net income from Class A common stockholders. Now, I'd like to make it clear that the non-controlling interest isn't inherently a bad thing for the company or for you as a shareholder. It's just something you have to keep in mind when looking at the income statement or the balance sheet, is that there's going to be a portion of that that's attributable to that non-controlling interest. So the value that's actually attributable to you as a Class A common stockholder is going to be lower than the total net loss, basically, or the total equity once we start looking at the balance sheet. Moving on from that, the last thing here on the income statement is their net loss per share attributable to Class A common stockholders. So this is after that non-controlling interest is subtracted out. And in this quarter, that was a 9-cent net loss per share, which is an improvement over where it was 1 year ago. Moving on to EVgo's balance sheet, they had cash, cash equivalents, and restricted cash totaling almost $230 million at the end of September this year. But this does include about $230 million they raised from share dilution during the second quarter, so keep that in mind when looking at that dollar amount there. Their general accounts receivable totaled $25.7 million, and accounts receivable related to capital build funding was at $13.2 million. Their prepaid expenses and other current assets are at $10.8 million, and that brings their total current assets, adding everything together, to $278.3 million. Moving on to EVgo's non-current assets, we start off with property, equipment, and software. This includes all of those chargers EVgo owns themselves, so that's why this number is so large. It's almost $400 million now at the end of September this year, and that's about $90 million more than what it was at the end of 2022. Their operating lease assets are at $56.2 million, and this does include the land EVgo leases for their chargers to be on. Other assets are sitting at $1.9 million, intangible assets $51.9 million, goodwill $31.5 million, and all of these added together brings EVgo's total assets to $817.3 million. Continuing on to EVgo's current liabilities, they've got accounts payable of $17.6 million, accrued liabilities of $38.1 million, operating lease liabilities of $5.7 million, deferred revenue of $19.9 million, customer deposits of $10.9 million, and other current liabilities of $61,000. So all of that totaled together brings their total current liabilities to $92.3 million. Then for the non-current portion of their liabilities, there's the rest of the operating lease liabilities. That's at $50.2 million. Earnout liability at fair value, $855,000. Asset retirement obligations at $19.4 million. Capital build liability at $33.4 million. Deferred revenue, $46.2 million. Warrant liabilities at fair value, $6.5 million. And all of these liabilities totaled together brings their total liabilities to $248.9 million. Then, if we subtract these total liabilities from their total assets, you get a book value of $568 million, which seems pretty good on the surface, but then you move on to their non-controlling interest yet again. Over here, you'll see $662 million of EVgo's equity is attributable to non-controlling interest, and that leaves the common stockholders with a deficit of $93.4 million. Now, real quick, I'd like to go back to their revenue breakdown and explain what this extend revenue is, because I think this could be something pretty important for EVgo going forward. This is basically a hardware sales side of their business where they sell their EVgo hardware to other companies that go on to own it themselves, but EVgo provides the installation and maintenance, I believe, for all of those chargers. So EVgo still has a pretty active role with that hardware, even though it's completely owned by a different company. In the third quarter this year, their extend revenue totaled about $10.5 million, which was about 30% of their total revenue for the quarter. But if we look back at their previous quarter, you'll see that extend revenue was a lot higher at $33 million, and this was about 65% of their total revenue. And I just wanted to highlight this because it is a pretty significant amount of their total revenue right now, and it's not very clear to me where this side of their business is going to be in the long run. To my knowledge, Pilot Flying J was the only customer under their Extend business, and that's where all of this revenue was coming from. But they did recently announce a deal with Meyer, so it looks like EVgo is still trying to expand their Extend business, and hopefully this will become a more stable source of revenue going forward. In my opinion, EVgo is a decent company with a lot of opportunity ahead of them just because they're in the EV charging industry, which I believe will continue to expand going forward. But it still remains to be seen when the company will reach profitability. Their revenues are growing at a good pace and their margins are improving, but I'm not totally sure if they're going to be able to make it without raising any additional funds, because you got to keep in mind that there are their expenses, and that's eating away their cash, but there's also they've got to invest in those chargers. So that's another huge expense that EVgo has to make. It's not technically an expense, it's an investment, but they have to spend that cash in order to continue growing their network. Another thing to keep an eye on is the introduction of the North American charging standard. Most non-Tesla EVs will now be able to charge at Tesla's chargers, which means networks like EVgo might see a hit to their utilization rates. But it remains to be seen how large that impact actually will be. I think EVgo is a good company to keep an eye on, but I don't think it's a great long-term investment at this point in time. There's still a lot of unknowns, and it's hard for me to see exactly where EVgo is going to be 10 years from now. If you enjoyed this video, I've got a lot of others on EV charging for you to check out as well. I'll see all of you over there, and thank you guys for watching.